Hello everyone. In the prior session, we explained the characteristic, the purpose of permanent funds. That's great. At this point, you should know what permanent funds are. But what's more important is to look at an actual example. Establish a permanent fund, show you some examples, show you some names of individuals, of generous individuals, show you the journal entries, walk you through them, close the entries, close the temporary accounts, prepare the financial statements, see the end product, and see how this works from A to Z. Whether you are giving a question about a journal entry or looking and reading the financial statements at the end, you'll be able to be competent in both. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Let's start with this example. Assume that at the beginning of year X4, Emily Generous, a resident of the city of Greenfield, noticed that the public library's condition was deteriorating, and Emily was concerned about the library's future. Why? Because she used to go there when she was younger. So what she did, she entered into an agreement with the city official on June 1st to provide the city with a $250,000 with the stipulation that the $250,000 be invested, the principal never to be spent, and the earning to be used to support the public library's operation. Well, let's go ahead and establish a permanent fund. We're going to debit cash, credit revenue, but it's addition to the permanent endowment. Notice we call it addition. It's revenue. It's a form of revenue, but we call it addition. What is the city is going to do next? Well, they're going to invest this money. The funds were immediately invested in M&N Corporation and bonds, which were selling at par. The bonds carried an annual interest rate of 6%. Let's invest the money. So we took the cash. We bought an investment. We increased the investment in bonds. We reduced the cash. We used up all the cash. Now the cash is down to zero. On December 1st, $7,500 interest was received from this investment. Because the bonds pays interest, we debit cash, $7,500, we credit revenue, investment income of interest. Notice here, revenue went up, cash went up. Now we have $7,500 in cash. What can we do with it? We can use it. Now we have some cash. And remember, this is a revenue account. And we also had another revenue account here. Remember, what do we do with revenues at the end? We are going to close them. Now, under the modified accrual, interest income that has been earned but not yet received must be accrued. Remember, we received the money on December 1st, but by the end of the year, we have 30 days left. We have to accrue the interest. Well, we have to accrue the interest for 1 month. We have an investment that's earning 6%, and we have to compute the interest for 1 month, 1 divided by 12. We are going to accrue interest of $1,250. We debit interest receivable. We credit another revenue. Now we have a third revenue, but now we have a new asset that's called interest receivable. And we're going to see all these accounts later on listed on the financial statements. I just point them out so when you see them all together, you'll see the big picture. Now we're going to spend some money. During X4, $6,000 was spent for public library maintenance. Remember her original intent, Emily's original intent is to do what? Is to maintain the public library. Well, we're going to debit expenditure and credit cash. Remember, we had $7,500 from the interest in cash, then we paid $6,000 for library maintenance. Now the cash account is $1,500. Don't worry, you will see it later. Now, remember we have an investment. If we have an investment, GASB required that investment are reported at fair value, recorded at fair value. So we have to determine the fair value of the investment. The fair value of the investment at the end of the year was $254,000, excluding accrued interest, because we accounted for that separately. So what do we have to do now? We have to adjust our investment. We're going to debit investment $4,000, credit revenue account another $4,000. Now, the adjustment is based on the difference between the fair value and the carrying value. And we're going to assume that the carrying value is 250. We did not make any adjustment to it. We bought it at par. There was no adjustment. Therefore, we have a $4,000 increase. And this is basically the typical transactions. Now, at the end of the year, we have to close the, in quote, revenues and expenditure. So we have to debit the revenues, 250, the original amount. We have to debit the revenues, the interest. Remember, the interest was 6,000 cash. And no, more than 6,000. How much was the cash amount? I know the accrued was 1,250. The remainder must be 8,750. Oh, the expense was 6,000. It was 7,500, which is the difference. What's left? Yes. So remember, the amount was, the cash was 7,500. So together 8,750 will have to be debited, and we have to debit the increase in the value of the investment. So we close those revenues. We have one expense. We credit expenditure to be correct. We credit the expenditure. And the difference is we have a fund balance now of 256,750. Now let's show you first the statement of revenues and expenditure. Again, this is the statements, the equivalent of an income statement, but for what? For a permanent funds. Revenues, we have the addition, the interest income, and the fair value adjustment, total of 262,750. Expenditure, just for the library, that's the only thing should be expenditure. This is excess of revenues over expenditure, quote unquote net income, 256,750. So this is how much the change in net fund balance. We started the year with 0, 256,750 plus 0 equal to the fund balance, or in quote the equity of 256,750. This is the income statement, equivalent of the income statement. Also, we have to look at the balance sheet for this fund. Remember, I told you cash, we have 1,500. The investment is reported at fair value, 254,000. Remember, we accrued receivable of 1,250. I told you you're going to see those eventually in the appropriate financial statements, and this is the appropriate financial statements. Total assets 256,750. On the fund balances side, we have the permanent fund of 250, and we're going to decide to have 6,750 as library maintenance assigned. Now, why 6,750 assigned? Because the fund balance was 256,750, of which 250 at all time must stay permanent. So this is the permanent amount, and assigned for library maintenance 6,750. So now the city official can make decision when to, or they talk to the library people, say, we have 6,750. Let us know if you have a plan to spend this money for maintaining, buying new books, or whatever you have to do to meet Emily's wishes to maintain the public library. What should you do now? Well, see if you can establish a permanent fund for your own public libraries, or go to Farhat Lectures and look at additional resources, MCQs, lectures that's going to help you, whether you are an accounting student, a CPA candidate, or just taking this course for professional development. Invest in yourself. Good luck. Farhat Lectures is always here to help, and stay safe.